Hello, and thank you for tuning into the MoorDoors Podcast, where we give you the tips that you need to increase your real estate portfolio and your wealth. Today's topic is, why do you need more doors? Now, when I say that, I of course don't refer to the webcast itself, though I do hope that you find it useful. But when we talk about doors in real estate, we're referring to units. You might own 5 properties, and 4 of them are single family units, and one of them is a 100 unit apartment building. Well, you might own 5 properties, but you own 104 doors or 104 units. And since a lot of the time in real estate, especially commercial real estate, we deal with a lot of properties that have several units, it becomes a little bit easier to talk about how many doors or how many units you control, as opposed to saying I own 5 properties, which doesn't necessarily tell you everything you want to know. So when we say doors, we're referring to the number of units that are receiving rent that you own. The topic of today's podcast is, why do you need more doors? What makes real estate such an incredible asset? In my opinion, and the opinion of many, the best asset you can possibly own. Well, we're going to get into that right now. One of the most important, most critical elements of real estate investment that makes it a fantastic avenue for wealth growth is cash flow. So cash flow refers to the amount of money that you receive and have left over after paying all expenses with a given real estate asset. I can't tell you how much it meant to me and how much my mental outlook shifted that first month after I had my first rental check when I bought my first real estate investment. That was strictly a purchase of an investment, not something that I'd once lived in, but some property that I bought just because I wanted to have a rental property, and I never lived in it. And I was working a job at the time, and I'd been in the industry for a few years. I was working really hard, trying to impress everyone I worked for, looking for ways to get that promotion. And you can work sometimes 3, 4, 5, even 8 or 10 years before you can get a significant promotion at work. And a lot of the times in many industries, a promotion might be as little as a 10% increase in your income. Maybe let's say you're making $50,000 and you get an increase to $55,000 or $60,000. I mean, that's great, but if you've worked for years to make that, that's a lot of time and energy into just getting finally an extra $5, $6, $7,000 a year. Now, when I received my first rent check after I had purchased my first real estate property, I realized that with my cash flow, and this was not an expensive house. I was able to buy it in 2016 for about $40,000. I put some work into it over a month or two, did most of it myself. And I calculated that with the income I was receiving, my annual income had now increased by $5,000. And this was a $40,000 house. All told, I probably spent about $10,000 total out of pocket to increase my income by $5,000, which means in 2 years, I'd made all that money back and had an asset that was basically free, making money for me. Now, that was a pretty good deal, and you can't always spend so little and get so much cash flow, but it's certainly realistic. And it's just that feeling of knowing that I could, instead of working for 5 years to get a promotion, which might make me an extra $5, $6, $7,000, I can just every year of my life spend a few $1,000s and get a property that then will give me that same raise. And it just kind of untethered me in a way that allowed me to feel very free and less pressured to be impressing everyone that I know and always making sure I say the right things. And of course, I do still have a day job. And I do try to say the right things and be impressive to my colleagues because I'm a hardworking individual. But the knowledge that my livelihood no longer is tethered to having the right person think the right thing about me, that was such a freeing experience and change in my mental attitude. So that brings us to the next advantage of owning real estate, and that is that it appreciates in value. Obviously, this is something you want out of any investment. Um, since 1968, the National Association of Realtors estimates that real estate appreciation has been approximately 6% per year, which includes during the downturn of 2007. So if you take the prices of real estate now versus 1968, on average, real estate prices have been going up about 6% per year. And that, I mean, it does vary depending on what market you're buying in. So there is some leeway there, but 6% per year is what the National Association of Realtors is estimating. And that's not that much less than stocks. Stocks are about, I don't know, maybe 6.5 to 10% per year, they say, depending on who you're asking. And is it the S&P 500 or are you investing in, Vanguard? I mean, there's all these different measures, but generally they say stocks appreciate a little bit faster than real estate does on a whole. But there is a really important aspect of that difference, that even though real estate is a slightly lower rate of return, it still is a much superior asset. And we're going to get into that next. It's the concept of leverage. Now, if you're not familiar with leverage, it's the idea that when you buy real estate, almost in every case, depending on the type of real estate investor you are, especially if you're just starting out, you're not going to be paying that entire sum. So let's say that you buy a $100,000 property, and it's a real estate property. If it's a property that you're going to live in, you can put as little as 3.5% down with an FHA loan, and some conventional loans are even as low as 3%, depending on your credit score and other factors. Now, if it's an investment, you're not going to live in it, you're probably going to have to put down closer to about 20%. So let's just use that 20% number. Let's not talk about something that you might be living in. Maybe it's a multi-unit. Let's just say you're buying some single family house or an apartment building, and you're going to be simply the person who owns it. You're not going to live in it. It's an investment. So you're going to probably put down about 20%. Now, if it's a $100,000 investment, that means you're going to put down as a down payment $20,000. However, because you are leveraging that property, because you are being loaned money from the bank to purchase it, you're putting down $20,000, but you own and get to benefit from the full $100,000 value of that property. That doesn't work in stock. If you invest $20,000 in a stock, let's say it has a 10% growth per year. 10% of $20,000 is $2,000. That's how much you would make in 1 year if you were to invest in a stock or a stock index that had a growth of 10% in 1 year. Compare that to 6% of $100,000. 6% of $100,000 is $6,000. And that is what you could expect with a 6% growth on a $100,000 property using that same $20,000 that you had put into the stock. So you get 3 times the profit, even though the annual interest rate for the growth of the property may be less than the growth of a stock. And this does not even consider that you're also at the same time getting cash flow from this real estate investment. So not only are you making more on your return of investment, but you get cash flow on top of it. You don't have to wait until you sell like you would with a stock. You get to put money in your pocket every month, and you're making more money over time as the property grows. That is a huge, huge advantage in real estate that you can't really match anywhere else. Now, real estate builds up equity over time, and if you are doing it as a rental, you're not paying for that. So you put down that 20%, and your renters are paying the mortgage, the taxes, the insurance, and you get cash flow on the side. So it's a fantastic deal. You put down this money one time, and then eventually you have a house that the rest of it is paid for, and you never paid anything else out of pocket. Of course, I'm simplifying a little bit. There's always repairs, and you might have some vacancy here and there. But in general, I mean, this principle holds true. You can also improve your real estate. So you can buy a property that's a little bit distressed, or maybe just a little bit less updated, and you can put some money into it. And let's say you put $10,000 of investment into a property, into improvements. Let's say you update a kitchen, improve a bathroom. They say that you get about double back. So let's say you spend $10,000. A lot of the times, if you do this strategically, the net worth of that property has now gone from, say, $100,000. You put $10,000 in, and now it's worth $120,000. So even though you spent $10,000, you basically get that plus whatever increase to the value, and you net more money by improving it. So that's a great way to improve the value of your investment, which, again, that's something you can't really do with stocks or bonds or any of those other types of assets. Real estate is tax deductible. The tax savings of owning real estate is amazing. So there are some very specific things that you can do with real estate that you can't do with other assets. One of the most important is depreciation. Depreciation allows you to take the principal or the initial purchase price of an asset that you've acquired and depreciate it, or deduct the cost from your taxes over the useful life of that asset. So for a house, the government, for whatever arbitrary reason, has decided this length of time is 27 and a half years, which means that if you purchase a $100,000 property, you will be able to deduct $3,636.36 every year from your taxable income over 27 and a half years. Now that is huge, especially when you start buying more expensive properties. Then that depreciation, a lot of the time, depending on the ratios of what your rent is, what you put into it, how much the property was costing, you can often depreciate enough so that you're paying virtually zero, or in some cases $0 of taxes on the income that you get from that property. It is a fantastic tool that you can utilize. That's a huge benefit. So then there's the idea that when you want to sell your property, it has a lower tax rate. Usually you will be subject to long-term capital gains if you've owned the property for more than 1 year, or short-term capital gains if it's been less. And this is generally either 15 or 20%, depending on how long you've owned the property, which is usually less than what your personal tax bracket is. So the income you would get from selling a property that has increased in value is much less. The taxes that you would pay when you sell your property are going to be less than the taxes you'll pay on the income you've made from a W-2 job or something like that. And finally, these taxes are actually deferrable. There's something called a 1031 exchange, which allows someone who is selling a piece of real estate to take all of those profits and roll them into another investment property. So let's say I sold a property for $100,000, and I had originally bought it for $80,000. Well, the government says I owe $20,000 in taxes for the amount of profit that I've made. However, I could set up a 1031 exchange and arrange to use that $20,000 as a down payment on another property. And in that way, I avoid paying those taxes. I defer them until the sale of that next property. And in theory, you could do this again and again and again and never pay taxes on those properties you until you die. And you can even defer it longer than that by, there's different things you can do by setting up certain trusts where you may never have to pay taxes on the profits you've made from selling properties, as long as you're using a 1031 exchange to buy more. Now, let's go over what we discussed today. Today we discussed why you need more doors, why real estate is the best investment that is going to increase your wealth and grow your portfolio. One, we talked about cash flow. We talked about that having that extra money coming in every month, month after month, is such a freeing concept that it will give you emotional peace of mind and stability. We talked about the appreciation of real estate, how it goes up in value over time. We talked about the fact that you can use leverage to buy real estate, and this cannot be understated as one of the most important aspects of real estate investment. We talked about how the value of real estate goes up in time without you having to pay for it because it's being paid for by the rent. So you put 20% down, and then depending on how long your mortgage is, 15 years later, 30 years later, you have a property that you own outright. We talked about how real estate is improvable. You can put in some improvements. You can upgrade the bathroom, the kitchen, the cabinets, and that improvement gives you more equity in your property. One thing I didn't mention is refinancing. Refinancing something that has gone up in value is fantastic. I have refinanced properties that I own to the point where and I'm being specific about cash out refinances, I've taken enough cash out of my properties after the values have gone up that technically you could say that I have $0 of my own money in any of my properties. It's as though I own all of my properties without having put a penny toward them whatsoever after having refinanced and receiving all my money back. We talked about the tax benefits of real estate, how it's depreciable. You can deduct a certain amount every year for 27 years to decrease from your taxable income. You can also deduct things like the costs of improvements. You can deduct the interest that you're paying every month for your real estate on the mortgage. Fantastic benefits. It also has a lower tax rate because when you sell your real estate, the profit you make is generally taxed as capital gains, which has a lower tax rate generally than your personal tax bracket. And finally, those real estate gains we just talked about can be deferred with a 1031 exchange, deferring the amount of taxes you need to pay perhaps until after you are deceased. You can defer your taxes so far out into the future that you may never have to pay them. And if you arrange it the right way, no one may ever have to pay them. I hope that you benefited from this information and found it useful. We will be coming out with a new recording every single week. There might be some bonuses here and there, but at least once a week you will get a episode from me, and we will talk about all of the things that you need to know in order to increase your wealth, increase your standard of living, and grow to be comfortable in your financial situation. Thank you for listening.